it used to work so well, and you could post directly to the Facebook page, but now, something, every now and again, when things go too well, they start changing things.
It used to work so well, and you could post directly to the Facebook page, but now
It's come up on my screen. The meeting is now streaming live on YouTube.
Yeah. I know it's I can see now. I just have to post it on the Modern Day Investor Facebook page, and we get going. Okay. Okay, so that's done as well. Perfect. Okay. Welcome to another episode of the Crypto Hour. It's Friday, the 17th of May. We're starting, 5 minutes late. Apologies for this. Let's get straight into it. So if you remember, the two things that we look into for to determine the next moves in interest rates are anybody remember that? One, inflation. Two, labor statistics. Okay, so we'll go and dive straight into that because we've had some news this week regarding that. So first of all, excuse me. First of all, this is this week's economic. Am I sharing my screen? Sorry, I'm making a mess today. Share screen.
Okay.
Okay, I'm now sharing my screen. This is the this week's economic calendar. So we've had two inflation announcements. The producer price inflation on Tuesday, there was slightly above expectation, but the more important one was the consumer price inflation on Wednesday, which actually came pretty much in line with expectation, with the month-on-month actually below expectation of 0.3. So it's starting to go in the direction that the Fed wants it to go, because remember their mandate is like around inflation below 2%. But this is not the main measure of inflation that they use. They use like core PCE inflation, which will be released in about a couple of weeks. But this obviously the CPI and the PPI are a major part of that as well. And by looking at these readings, we can start guessing pretty much what the PCE reading is going to be like in a couple of weeks' time. For today, there isn't much to expect in terms of news. So this was the inflation was the first part of what we're talking about. The other part was the job figures. And this is probably, we'll talk about why the Fed at the moment is not too worried about inflation, even if it's, it's still quite a way away from where they want it to be. But why are they talking so calmly and without any need to raise interest rate? They pretty much ruled that out. Because we're starting to get some signs that not all is well in the employment figures. Okay, so this is on, if you remember, on the 3rd of May, we are the probably the most important job figure for the month, which is the non-farm payrolls, non-farm employment change, which came well below expectations. Okay, almost like halfway from the month before. So we had 315,000. They were expecting about 214. And instead the number was 175. So then every week, or every Thursday, you go see the unemployment claims are released. So we look at that as well to see what's, how are these numbers being reported. So this is yesterday, okay, and we see here, jobless claims 4 weeks average going up, continuing jobless claims going up again above expectation, and initial jobless claim again above expectation. Okay, so those are the things that the Fed will keep an eye on, because the two mandates are to keep inflation, within a range of 0 to 2%, and to keep the America in full employment. Okay, so at the moment, why are they not that bothered about the inflation figures? Let's try and work something out, and let me show you. Sorry, let me go back. So if we see this is the measure of inflation that the Fed uses, and this is what we can expect it to be when it's released in a couple of weeks time. Okay, so probably the PCE will come out as unchanged, with a downtrend in the recent movement in the past few weeks, but at the same time, the yearly figure should be unchanged at 3.1%. Okay, but why are they not worried too much? Because there are, we need to go into a little bit how inflation is calculated, and different classes of goods that are looked at to judge, to come to this figure of 3%, which is an aggregate of food, housing, mortgages, and there's lots of it that goes into the inflation calculation. So if we look at that, at the moment there is like about 64% of items that are above the 2% target rate, and about 20% they are actually disinflationary, so below 0%. Okay, so but as you can see, the amount of items that is above inflation, which was over 90% at the end of 2022, beginning of 2023, has steadily been coming down. Now, what is keeping this level up so much is this this purple line in the middle is actually the core inflation. Okay, what you can so the items that form the core inflation. Although this has been coming down as well, it's still well over 4%. Okay, now though, how is the purple line actually created? That mainly, okay, the main component of that, 60% of that, is housing costs. Okay, and the measure that is used to calculate the inflation, so the housing figures that are used to calculate inflation, come from the Bureau of Labor Statistics, which uses figures that are pretty much like 6 months old. Okay, so if we were to use market numbers, and this is another graph that's interesting to look at, from WisdomTree, using averages of Zillow and Apartment List instead of using the Bureau of Labor Statistics, we will come to a figure of about 1.8%, as opposed to about 4%, 3.7%, which are the official figures with the Bureau of Labor Statistics numbers. Okay, so this is what they see in real time, basically. So think that the Fed, they're not stupid at the Fed, so they can see these numbers in real time, and they know that just the stance that they have at the moment in keeping interest rate unchanged is restricted enough so that these figures, they are lagging, a lagging indicator, basically. They know that they will catch up to the real figures, which are showing a gradual reduction of the increase in pricing in rents, for the housing sector, because of deterioration in the economy that is starting to bite at the moment and making its effects felt in the labor market. So if we see this is the employment rate And especially this is a very respected way of measuring it, which is the Kansas Fed Labor Market Condition Index. And when it goes up, it means that it's, you know, the labor is deteriorating. So this is, you know, unemployment rate that, as you can see, started climbing quite rapidly now in the past few months as the effect of the tightening, the interest rate raising, as actually is starting to be felt in the pockets of companies, and as a result, you know, companies that have to refinance their debt at a much higher cost means that they are holding on employing people. Okay, and so then we see the unemployment figures going up, and as a result, there is less money in the economy to be spent. So the company cannot make as high profits as they were making before, and so on. It's a kind of like snowball effect. And if we go back a little bit and look at this, maybe could clarify the things a little bit. If you look at the bottom, this is how the mortgage market composition is across different countries from Europe to Australia, you know, Canada, the US, and so on. So if you see in the US, you know, the majority of the mortgages are long-term fixed, so 10-year plus fixed rate mortgages, and only around 3% are variable rate mortgages, like so up to 1 year variable or up to 1 year fixed or a variable rate. So you can see that it's, you know, this is why it's taking so long for the raising interest rates to actually be felt in the economy, because a lot of people and company have fixed their funding at a low rate at a very, very long expiration date. Okay, so that is something that, you know, it's very gradually working its way in the economy, but it will take its time. Okay, so at the moment, what the Fed knows that, obviously, and they know that they are going in the right direction. What they are worried about, though, is the labor market, because if that deteriorates further, then they might be forced to lower interest rates, even if the inflation is still above target, which would be a no-no normally in you know, for the Fed. You know, and you will see also the difference here with, you know, the countries that got a bigger percentage of you know, of variable rates are the ones that have felt the effect of you know, this increase in mortgage rates straight away. As soon as that happened, you know, and you guys in Australia, you know, you probably know it. You know how much, you know, what difference it has made to your pockets, you know. So this is the reason why I think why is the, you know, American economy, you know, on the outside looking so buoyant at the moment. It's basically for this reason. It's just that they won't feel the effects. They will just feel the effects a little bit later. It's almost like, you know, a delayed effect.
Luca, a
Yeah.
couple things. Now I know a number. I'm in the U.S. actually at the moment, and there's a lot of I'd say interest rates probably are having a much bigger effect on the business side of things versus, you know, the personal side, because if most people have locked it in, that it's unlike New Zealand, you can only fix it for 5 years. Here, you lock it in for the 25 or 30 years of your mortgage. You know, if you've got 3 or 4%, there's no way in hell you're going to give that baby up. You know, at this moment, there's, you know, you'd be stupid. And then there's not a lot. At least I'm in California at the moment. There's some housing market that's out there, but you know, those people are the part, you know, going to get the ones that are going to get zapped with the 6 and 7% interest rates. But there isn't a lot, you know, selling. They're selling, but it's just not, you know, a lot. But you know, I think to me, wouldn't the deterioration be if you've got corporate debt that's got to be resurfaced and it's not as cheap as it was, and then that puts extra pressure again, and people aren't buying. So the business sector, wouldn't they be, you know, then they got to lay more people off. So I'm just saying that seems to be probably the end of the stick. That's probably the worst side versus the home mortgage side. or not?
I think you're spot on. I mean, there are two things to consider here. First of all, the effect of what you are talking about is that because people will not want to give up their mortgages unless you have completely paid off your mortgage, and then you can sell your property and not worry about it. If you sell your property and you need to then have another mortgage, then obviously the cost is much higher. So it's a disincentivizing people to to be active in the housing market. And this is why the housing market has gone down so much because there is little activity in it. Definitely, the sector that is most in danger at the moment is the commercial property sector, because again, already at very low rates that we have had for many years, a lot of these big commercial property deals were borderline already at that level. So has some of these deals now need to be refinanced? They're just simply not viable at this higher rate. And what this could end up sinking is a lot of the small and medium-sized banking sector. They are more which are these sectors normally they have lent money to commercial real estate. And this is going to be felt. I mean, we already had a couple of bank failures last year. There probably going to be some more this year. We'll see a reorganization on the banking sector with less players and bigger players in it. But definitely it's all combined. Obviously, if although people are not going to give up their long-term mortgages, but some of the long-term mortgages now are coming to being renegotiated, and although it's a trickle effect, it's felt anyway in the economy, because that means that people spend more money to pay their debts, they spend less money as a discretionary spending in buying goods and services that that then work their way into the economic wealth of the nation. So there's no running away from it. So there is no magic formula that can that can make these things disappear. But this is why there is a big effect whenever we hear the Fed, like in this case Jerome Powell, talking down possibility of increasing rates. The effect is the market takes it as good news, because I think, okay, good, they're going to cut rates now, so it's like good times for everyone. But there are a few things to also consider. So this, for example, it's the volatility of different markets, and there is kind of like a peak that we have gone through, and now we getting into levels of very low volatility, which are dangerous in themselves because they bring market complacency. So if I just move on from here, and we'll show you something else. So this is the VIX, which is basically a volatility of the stock market. Okay, and if you can see here, historically speaking, so I'll bring it back in kind of the all-time volatility. But can you see how low we are at the moment? We are pretty much, just playing around with levels that are, at an all-time low in terms of volatility. And definitely we are at the, just recently we created a new low for 2024 on Monday. And we are anyway in that at the lowest we've been for the whole year. So what does that mean? It's simply, if there is no volatility, it means that, prices, doesn't mean the prices go up or go down. Okay, it means that there is little change and prices may be grinding either higher or lower. This doesn't tell you if things go up or go down. Okay, it just tells you how the range, the prices move, within a certain period of time. So, originally, when you see such low levels, it means that the market is very compact, and they all think the same thing, basically. Okay, so they all expect this current price, the kind of trend in prices to continue uninterrupted. Okay, and obviously when views are extreme, either in one way or another, it means that normally there is a surprise, as every time that this has happened in the past, as you can see here. So if I bring here the weekly chart, it goes all the way down to early 2000s. You see that every time we've been into this range, there is then been an increase on volatility quite significant that could bring, I'm not saying that we're going to see similar levels here of volatility, but you can see the difference here. When we go into 2008, we're going from very low volatility to extremely high, and this example here is 2020. So at the extremes, there are opportunities for things to, when something surprises the market, something that they don't expect, normally there are reactions that are felt straight away. So I'll just give you the most recent example. Okay, so we can see this is on the daily chart. So the most recent high is this one, 19th of April. So if we can see here, so this range pretty much, okay, this range here goes from the 12th to the 22nd, okay, or with a high on the 19th. So if we look at the S&P 500 during the same period, okay, so this is the same period of the 12th to the 19th. You can see our volatility increases, and so what happens? So this is the trend, the recent trend. When people start getting nervous for one reason or another, the volatility increases. Then you start seeing then occurrences they are against the current direction of travel. Now, it doesn't mean that this is going to happen tomorrow, and there is definitely room here in terms of how low can this index go. There's still a while to go. Another 10% it could drop to be at a historically low levels. So I'm just saying it's kind of like a warning sign that we can see in the markets that we need to be aware of. Okay, so it's not. I would say there are expectations in the market that interest rates are going to be cut, whether early or late, and that will bring kind of new excitements, new greed into the market. Okay, and when that happens, when there is moments of extreme greed or extreme fear, this is when opportunities happen in the market. Quite an interesting indicator is this one you can get from CNN. Okay, the fear and greed index. Okay, at the moment we are in greed, but we're not really at extreme greed that will kick in after 75. So there's still a little way to go for that. But if you look at levels of level of extreme greed always precede a drop, to go to normality, back to normality, that will bring, will push prices in the other direction. So if you can see here, for example, we were extreme greed at the beginning of April, and then we had this drop, the one that we saw to 12th to the 19th of April. Just very well predicted by the index, and historically, every time we have pushed into these levels, have been followed by a period of movement in the opposite direction. So it's something to watch in general, but in the current time frame also in particular. Now let's go to our friend Bitcoin, and the age-old question is, are we there yet? So let's go and have a look. Let's go and have a look at Bitcoin. Okay, so what chart have I got here? I'm sorry, just a second. Okay. So as you can see, this is the up here. We have the the all-time high in March. Okay, up here. Okay, and since then, what has followed is we've established kind of like a downtrend in prices that makes succession of lower highs and lower lows, and this was the last one of these moves. Okay, so you can see at the moment, at least you can see how vertical some of these lines are, and the lines going down are stronger than the lines going up. Okay. So obviously we have recovered quite a lot from a low of 56,000 to where we are today, which is about 66. But there is, the one thing that I am watching to see the strength of the market is, are we going to beat this or not? Because this is, it's a pivot, which in trading we call like the controlling swing high of this current downtrend. Okay, so when this is broken in a significant way, which will mean either a 4-hour candle or a daily candle closing above it, until then, the moment is still, we can say that bears are still in control. You can see this as the battle between bulls and bears. Okay, so although the bulls are trying to push higher at the moment, this is the line in the sand. And I don't know if we will go against it today or at the weekend, but can the bulls here have enough momentum, enough strength to push past this level? Because if we don't, if we have, at the moment we can keep this level of around 65, then the probability of these moves is that price can either go up or go down, and if we can't beat that, the probability are normally saying that then we're going to push lower. Okay, so it's something, a level to watch at the moment. I wouldn't say we are completely in the bull market. If I should, talk about probabilities, then I would say that the probability to make a new high and push towards 100,000 are higher than the probabilities of testing the 50,000 level. This is how I see it. But we need to be objective. We need to be objective, and at the moment, this is still holding. So until this holds, we need to respect it. Okay. The moment it holds, the moment it's broken, then what we tend to do normally, the way this works is just like it will break. Sorry, let me start again. So this will probably carry on doing something like this, for a little while, and then break higher. Okay. So once this breaks, this then becomes a demand structure, which we could be used to re-enter the market on a pullback. Okay, then we would expect the market to do something like this, and then move higher, and probably there would be another pullback before breaking the all-time high. So this is are they going to stop around this point, okay, or around this point? But the likelihood is normally that we don't know how deep is going to be the pullback, but this could represent a nice area to re-enter the market once we know that there is strength in the demand size. Okay, so this is the Bitcoin analysis. The answer to are we in the bull market yet? Not quite. Okay, not yet. We haven't really started moving yet. And if you look at the some of the the altcoins, something like in this list, I would say most of them have actually gone down in the past few weeks rather than going up. Now, Bitcoin is recovering, and it generally recovers faster than the altcoins. And once there is like good vibes going on in the market, then the altcoins start really pushing off harder. At the moment, we haven't seen that yet. Okay, it's still in consolidation mode, but there are a few noises, a few things that we can examine to have a look of the direction of travel. So in the past few months, we talked about the Bitcoin ETFs. Okay, these are the latest figures for Bitcoin spot ETFs inflows. Interesting. So this week have been all positive, and it's not surprising seeing the prices of Bitcoin going up. So these are the figures in US dollars. So we see 300, 600, roughly $600-700 million have gone in this week. Okay, these are the figures up to yesterday. And interestingly, so what you notice that is different is now we are starting seeing some green numbers, even on the Grayscale Trust, because they changed things slightly, so people don't need to sell as heavily out of that, and probably, excuse me, it will settle at figures that are similar to the BlackRock ones. So at the moment, GBTC is still the biggest fund out there, but it's getting quite close now. Okay, so 288,000 Bitcoin against 274 from BlackRock. Okay, so the one thing to notice is that this selling pressure coming from Grayscale have definitely slowed down, and that could make a big difference, because now the impact of any new funds coming into this are more likely than not going to be positive rather than negative. If you want to see the figures in Bitcoin, these are in Bitcoin terms. I mean, they're not huge figures, so we're talking about 1,000, 4,000, 3,000 Bitcoins, but we are still at 222,000 since the ETFs were launched, which again compare it to roughly 20 million Bitcoin in circulation, would make around a 1% plus of Bitcoins. They are now locked in ETFs. Okay, and ETFs historically are very slow movers in terms of money coming in and out, and generally funds that are in the ETFs are staying there for a longer time. Now, another thing that it's interesting to look at is to put that into perspective of this. If you've been following that, you would have noticed that in the past couple of weeks, it's been inflows, outflows. Pretty much we stayed where we were last month. Things haven't changed very much. But when you put it into perspective, you realize what this means compared to other players. So have a look at this. Okay, these are the new the biggest launches of ETFs in 2024. Okay, so when I say number of holders, they actually report that they have these funds in their books, and they have to be reported if you are a publicly listed company. Normally, if you have, like, for a new fund that just been launched, if you have 20 plus, it's a big deal. Okay, so it would be a very big deal for a newly launched fund to have 20 entities reporting that they bought shares of that fund. And you can see, apart from the 4 Bitcoin big spot Bitcoin ETFs here, all the others, none of these have actually collected 20 plus reported. Okay, which is, so this is kind of like having 400 entities reporting holding IB shares, it's mind-boggling. Okay, even these figures, even the other three are mind-boggling, but this one is just like unbelievable. Something that is never ever in the history of ETFs that goes, 40 years back, has never happened before. Okay, so this is how I'm trying to put things into perspective. These are the just a small number. So the 10%, the top 10% of investors in the Bitcoin ETFs. So these are the different ETFs, and these are all the corporate investors, and what kind of ETFs are they invested in. Okay, so you might or may not recognize some of those names. Is not too important to go and dig into these names, but it's more interesting to look at this to see what are these people, what do they do? Mostly 68% are hedge fund managers, 22% investment advisors, and then there's some like private equity, some pension funds, and some brokerages. They're starting to have issue, even some banks now. 1% of that is held by banks. Okay, so generally speaking, so who moves faster? So and this is not surprising. Who moves faster is obviously the hedge funds. They are more mobile, can move funds a lot quicker than pension funds and banks and insurance companies. So these will take a lot longer, to have a significant position in Bitcoin. But it's quite interesting to see that 22% is held by investment advisors, and who think advises individual investors, to buy these products are investment advisors. So all these, they're all things that take time to appear then in numbers, but they're all like again stepping stones that we see are being established, and progressively would show the effects of this activity in Bitcoin prices. Now, couple more news, and then we can go and have a discussion and have some questions. So this is the reason why this is coming out, because it's the recent kind of like filing deadline, and so we can see now, we can read the filings. Okay, this is showing the major firms are how much they invested in spot Bitcoin ETFs that they have declared on the balance sheet. Another thing that it's worth talking about today, it's what could be a big deal, although it's looked like legalese really, if you want to start reading about this. But it's something that's going through the Senate at the moment, which was passed yesterday by a bipartisan group of senators. So not necessarily just the one party that is pushing this, but quite a significant number of Democrats have actually broken rank and supported this legislation. Now, what does this do? So they are looking to reverse. This is really obscure. Okay, to overturn the Security and Exchange Commission, the SEC, Staff Accounting Bulletin SAB number 12. Okay, now what this say, and the vote was 60-38, so quite strongly in favor of this. This was implemented in 2022, that forced the digital asset custodians to list digital assets as liabilities on their balance sheet. Okay, there's this paragraph here. So, which was a requirement that's criticized within the crypto community. So, because these, the custodians are, they are keeping these assets safe, but they're not their own assets; they're somebody else's. So they shouldn't be seen as liabilities. And as a result of this, bulletin or whatever you want to call it, the custodians were forced to keep the same amount in the books in cash as they had crypto they were keeping safe for their customers. So let's say Coinbase, if they had like 1 billion of Bitcoin, they would have to hold 1 billion in cash to offset this liability on the balance sheet. Now, obviously, this will slow down the adoption of cryptocurrency because it causes a big problem in terms of liquidity. And it's what Senator Warren as well, which has been against crypto for all this time, has together with Gary Gensler, or they put all these stumbling blocks in the way of crypto. Now, President Biden has said before that they might veto this bill. So it remains to be seen. Now they have like 10 days to veto, sign it, or do nothing. If he did nothing, would mean that he would go into law without the signature. Okay, so it could possibly, there are two positive outcomes for crypto. It could be signed or actually would be passed without a signature, and the negative outcome would be a veto, presidential veto. So we are now waiting. We've got 10 days. So by next, we'll see, probably not by next week, because there's still a little bit of time left. But in the next couple of weeks, we'll be able to see the result of this decision. And this could be, although it's something that will probably go unnoticed, and you won't read it in very many places because nobody understands what it means. But this could be a very big deal for crypto. In why it could be a very big deal is because it would free up a lot of institutional investors' money. So this could potentially be the single event that could start a bull market. Okay, but we'll see. We still got 10 days, and obviously they've been fighting this thing tooth and nail. So I wouldn't be surprised if this got vetoed again. Okay, but we'll see what happens. Couple more things, and then we'll stop sharing. So again, the supply of Bitcoin on exchanges, although the price is not doing anything, these relatively low prices are being used by whales, big holders of Bitcoin, to accumulate. And this is seen also by the supply of Bitcoin on exchanges becoming lower and lower, which is falling to all-time lows at the moment, to the point where they're starting making noise and saying that they might run out of Bitcoins in 9 months' time if things continue at the current pace. So I leave you to imagine what that can cause to price, because remember, especially as institutional money comes in, they drain quite a bit of this liquidity, because there is only a certain number of Bitcoins in circulation. We know that the maximum number ever would be 21 million, but also you got to realize that many of these Bitcoins are lost forever because of early days mining and hard drives being lost, and they're in places where they cannot be recovered. So the theoretical number at the moment is below 20 million, but the real number of Bitcoins is a lot lower than that. So every Bitcoin that gets taken out of circulation reduces the amount of supply. And as we were talking about last week, the halving means that there are roughly 500 Bitcoins less in circulation every day. Okay, coming in circulation every day. So the accumulative amount of this less supply. So it's from the point of view of price, it's a relationship between supply and demand. So it's the same effect whether demand goes up or supply goes down. So the effect that we will see, and progressively getting more felt in price, is basically 500 Bitcoins a day. And 500 Bitcoins a day are quite a serious number, because if you see, let's see what the Bitcoin ETFs are doing. If you see over the last few weeks, there isn't that much and that amount that was actually paid in. So this is May only, but this is like 6,000, 3,000 minus numbers, 100 in. So it's like these days, look at these days here, for example. So the amount of Bitcoins in the market will overtake on some of the slow days the amount of Bitcoins they are accumulated in ETFs. Okay, this is like 1,000, which is just double the amount of less supply in the market. So this is on this day, for example, the effect on price is 1,000 Bitcoin being taken out and plus 500 of supply less in the market because the miners aren't getting as much. Okay, so over time, 500 Bitcoin a day, 15,000 a month, about 100,000 Bitcoin within 6 months, within a year is 1%. The effect of that is 1% of the level of Bitcoin, of less Bitcoin in circulation that there were like being produced last year. And the last thing that I wanted to bring to your attention, one of the most interesting projects that are there right now, although it's not, it's not a meme coin, okay? So it's not the one that excites everything, but Chainlink is something that they just had a pilot project with several major US financial institutions to tokenize securities. Okay, so they could, because Chainlink has done a lot of work with crypto sector and outside the crypto sector, and I remind you that an oracle is something that stands in between the real world and the smart contract world. Okay, so one that translate what's going on in the real world to be used by smart contracts. So it's something that is needed. What they offer, and obviously it's not just Chainlink, but they are the biggest oracle out there. But there are many oracles that are just on one blockchain, for example. Chainlink works with several different blockchains. So it's one of those projects that needs to be there, needs to do well for crypto to do well, because they provide all this data, and now they also offering their services as well to the let's say the non-crypto financial world, and is showing that they are showing this, people like Bank of New York Mellon, Franklin Templeton, Invesco. So these are JP Morgan. These are some of the banks that have taken part. They are showing them how blockchain can reduce costs for them. So facilitating interoperability in financial markets. So at the end of the day, businesses care about making more money. So if you can show them ways of, doing what they do, but earning more from it, obviously they are happy to, to go along with it. So that's the Chainlink is probably going to be a very big player in what is called, which is a growing sector in crypto, which is, you might see as RWA, real world assets, tokenization. So they are probably going to be a very big player in tokenization. So it's something that I hold very dear as well, and hold in my portfolio as well, because of that reason. Okay, I think I can take a breather now. Let me stop sharing and see. Let's get some questions. First of all, actually, let me ask you a question. How many of you enjoyed the session last week with Jonathan? That was epic, and I think both Jonathan and I enjoyed it very much. So we'll be looking to do that. Maybe Jonathan, sometime in June. What do you think? We'll do a deeper dive into some a blockchain again, using Cardano as an example, and we'll go a little bit deeper than we did last time. Yeah,
that'd be really good. Maybe in a particular sector.
Yeah, no, fantastic. Okay, let me see. What are the advantages of investing in Bitcoin ETFs if I'm already accumulating Bitcoin? None whatsoever. Really. So if you're already buying Bitcoin, you don't really need the ETFs. You know, the reason why the ETFs are important is to allow one is the people that are not crypto friendly, let's put it as a crypto technologically minded to buy Bitcoin using their normal investing infrastructure. Okay, so through their broker, through the bank, you know, anyway you use to buying stocks and shares, you can buy that with. And secondly, it's something that needs to be in place for institutions to buy Bitcoin, because institutions are a different animal in the sense that there are certain things that are determined by the statutes, and so there are certain investments they can do and certain they can't do. Okay, and the ETFs being there, it allows them to have a investing structure that they can then use to hold these assets, which they couldn't otherwise do. So yeah, that was the main reason, Barry. Okay, any other question coming? Anybody got a burning desire? Come on, don't be shy. Don't be shy. I don't bite. I may rubbish what you say, but that's you know, that's my prerogative. No? Nobody? Oh, well. Oh, okay, so what would you like me to do? We got 5 minutes left, 4 minutes left. What would you like to look at? Eric.
Look, I can keep on hearing about the interest rate in America going down, and they're betting on it. It will not, it will 1 time, 2 times. How will that affect us here?
Okay. The main thing, let me share my screen again. This is something actually I meant to talk about earlier on, and then I didn't. Okay. So there are a couple of things that you can, look at. Generally, the most liquid ones, this is the 10-year, the yield on the 10-year bond. Okay. So we've seen as that went after Jerome Powell. You can see up here went pretty much from 4.75% to the current level about 4.4. Okay, so this is like 35 basis point, roughly, and nothing has changed. So for this to happen, so this is the price when you go and buy bonds. You say this is what you get. Okay, so obviously the more this goes down, the more the prices of bonds goes up. All right, and the effect of that at the end of the day, it's first of all is what it's the easy pickings for an investor. So an investor can go in, buy bonds, and get this amount of interest. So the higher it is, then the more incentive there is for people to just keep bonds in their portfolio, because they're paying them a lot of interest without taking any risks of investing in stocks and shares. So when this comes down, the main thing, how do we feel, especially in Europe, away from the US, is that this comes down and shares go up pretty much, because it's seen as, you know, less expenses for business to be in business, to finance their businesses, and so they can then and also less money for people to spend, because the 10-year and even more the 20-year, this is the 20-year yield, which it was even higher, was about 5% before the speech, and is now up 4.63. Okay, so these are the interest rates really that are used as a base for mortgages, you know, to calculate mortgage rates. So the more this comes down, the more money both people and businesses have to then spend in the economy, for businesses in terms of investments, for people, you know, spending money, discretionary spending money to buy goods and services that companies then sell them. Okay, so that's the real effect. and this, so this is why so much importance is given to every time Jerome Powell speaks. Okay, so it's not necessarily the numbers that are announced, but just the tone of his speeches that can determine this to happen. Okay, and we can see the result of this in the stock market again. So this is, if you see, this was the 19th of April, okay? 19th of April, when that's a few days later. Okay, so this is, so there was like a bounce after the speech, and then things went down. So this is a week after his speech that the market started pricing already interest rate cuts. So that already tells you that they're expecting pretty much like 2 interest rate cuts this year at the current price levels, and that's already being priced into the bond prices. Okay, as this gets lower, as interest rate cuts started actually happening, and the expectation of the markets become for lower rates, especially if there are reports of inflation going down and the job market getting worse. So as a result, the expectations are that, you know, the Fed will have to cut interest rates. And although it's a bad news for the economy, you will probably see as a almost like an adrenaline injection for the stock market, because it's seen as lower costs. So you know, all we can say is that, you know, it's not immediately logically understandable. But if you're thinking, well, why does the stock market keep going up if the economic conditions are actually deteriorating? It's because they see simply as, okay, there's going to be more money around, more money going around for everybody, and that's the result. And at the moment, you know, just remember that greed is the dominating emotion at the moment in the market, and people forget, you know, when they see something like this happening, they think that it was going to carry on happening forever. And you know, the funny thing is that you know, the more it goes up, the more people want to buy it, you know, until it gets to an inflection point where people still carry on buying, but all the big institutions are selling, and then we'll see you know, sometimes the big drop that we see in the past, something like this that we saw in, you know, 2022, for example. Again, you had a similar uninterrupted period of growth, and then, you know, a big drop in price. We're seeing something similar right now, maybe not as strong as, you know, because we had this big drop in 2020. So this, you know, the incline of this move is not as strong as this one, but it's very similar. It's very similar. So if we actually were to measure, if we just ignore this big move, or we just go from here to here, sorry. You see, it's quite similar to the move that we've had right now. Okay. So would that be surprising if we saw something like this? It would be surprising probably at the moment, but at some stage, you know, whenever there's a rapid growth, a correction is to be expected. So that's the risk that we're running at the moment, is something like this. Okay, so a drop of a 20% plus, like what happened in 2022, it doesn't mean that it's, you know, it's going to start right now. So that's the move that we had in 2022, but we could expect that to happen, you know, not from where we are right now, but I would expect at least probably another 10% climb from where we are now. So if we were, let's say, to start dropping once we get to about 5,800 something, probably if you're thinking about when could that happen, that would be probably after November, after the elections. Okay. But if we were to climb it about 10% from now and then drop, that would take us back, still in positive territory for 2024, but it could take us down to what the expectations were last year, to maybe to around 4,600 to 4,800. There was the expectation of the market to be in at the end of 2024. So I don't know. At the moment, I'm feeling. So it's not like I am kind of like a negative, like a Sandra. They always gives negative, expecting the worst thing to happen, But at the moment, things are going up. So you go with the trend, and there's no other way to, you don't really want to go against the consensus of the market. But at the same time, you need to be ready for a deep correction to happen, because we really haven't had that from October of 2022. Okay, so a 20-25% correction is something that can happen during bull markets, and I wouldn't be surprised if we got that later on in the year. So that's what we can expect, Eric. Answer again, a long answer to your question, but this is how interest rates can affect us, because the American stock market is the largest in the world, and again, bond market and so on. So that normally leads the way for all other markets to follow. So if the American market drops, so will the European ones, and so will the Nikkei, and the Asian markets will do the same thing. So that's the one thing that I keep seeing far too much greed in this market. Everything we just expect to, like, new highs to be hit almost on a daily basis, and that starts making me a little bit nervous when everybody thinks that one thing is going to happen. Normally the opposite happens. So this is not, don't quote me from this, but it's just like almost like a feeling that I have borne by having been here before in the past.
Thank you very much, Luca.
No problem. Okay, guys, we've run out of time. So Jonathan, as usual, put the link to his Cardano session. And these are some of the things that is going to talk about. So the A-Starter, Cornucopias, Machiavellic, YAM4 loans, and Orfax validator. And again, I would recommend you to follow him, especially if you are interested to really learn something real about cryptocurrency instead of just looking at prices. And Chad, we may talk about that another time. I think we're out of time today, but maybe next week we can talk about that. But I will say at the moment, though, just to say one thing, is too early to go in the other direction. Okay, you need to go short on the stock market at the moment. So at the moment, if the only thing that could be some plays by somebody that's got a large stock portfolio would be to maybe buy some protected puts, because those at the moment are fairly cheap. Okay. So I will wish you all a fantastic weekend, and again, I'll talk to you again next week. All right.
Thank you very much.
Bye bye.
Bye, Luca. Have a nice weekend.